mean, we were buying 10 million a week, many weeks of distressed assets. And those deals came out fantastic. So I am wildly optimistic, one, about the US overall over a long period of time. And two, in downturns of the market, this is the best time to be buying. Absolutely.
Hey, everybody. Welcome back to another episode of the Richer Geek Podcast. Today, we have Nic DeAngelo. He's president of Saint Investment Group. This guy's, I don't know, he's pretty much done it all. We're talking 24 projects, 500 plus loans, 20 state portfolio. He's the leads that veteran team that acquires institutional grade real estate assets. And now we're going to also talk about some other type of things about fixed income funds and some of the things that you may not realize that you can do. How you doing, Nic?
Mike, I'm doing great. Great to catch up with you here. We were just figuring out that we've known each other for a minute and spoke at some of the same events. So always great to catch up with you, man.
Yeah, it's our dear friend Hunter Thompson, and I mean, he's just kicking it too. And it was great to meet you at the conference where we both spoke. It's been a couple years ago, but it's like, where do we know these guys? Where do I know Nic from? It's a small circle, and it's a great circle to be in.
Absolutely.
So for our listeners that don't know Nic, give us a little background, and where you came from, and how did you get started in creating Saint Investment?
Yeah, I mean, it was, my eyes were locked on real estate from an early age. So I was blessed to kind of see some people, some friends and family be really successful in real estate. I'm a lifelong entrepreneur with the idea that I always wanted to be a professional investor. I thought the only way to do that, because early on, the industry wasn't as evolved and sophisticated like it is today. It wasn't as easy to invest. There's all these options, LPs, GPs, great syndicators, great operators. It wasn't like that back then. So you kind of had to have a lot of your own money, and it was kind of not as transparent. So I went heavily into entrepreneurship. I've been able to, with an amazing team, build and sell some great companies along the way, and be investing in real estate all the while. My career started in the real estate side very early on with a couple family offices. So I'm classically trained with just absolute behemoths, lions, giants of what they do. And I worked very closely with the patriarchs of those. And I was blessed to make early friends with amazing mentors and learn as much and try to add as much value as I could. So fast forward to today, Saint just crossed 200 million, 206 million in assets under management. Like you said, we're just over 500 loans in our portfolio. We are focused on fixed income today. And that really was, a lot of our investors are a lot older generations, very successful. Many are successful entrepreneurs in their own right. And they were just kind of hammering us going, the syndications are great, but we're transitioning in a life stage that is looking for something more stable and a little more flexible. So we leaned all the way into the fixed income side and saw a big opportunity to deliver there. So we offer, some pretty amazing high returns, a lot of flexibility, and we focus on rock solid kind of 20, 30-year plans in the mortgage industry. So that's kind of where we're at today, a little start to finish.
So for those people, it's like, okay, fixed income. Yes, I make a salary, that's fixed income. Someone that's on commission, let's say, I wish I had fixed income, or not. Give us a little bit. What do you mean as far as what you do, how you do it? What do you mean by fixed income?
So all those are a degree of fixing of income, on that side. What we focus on is an investment vehicle for high earners that balances out whatever else they're doing. So on my side, being an entrepreneur, there was times where if you look at a quarter or you look at a year, we're killing it, right? The company's just, the growth is ridiculous. I mean, it's, stratospheric growth. Everybody's doing well. Company's good. Culture's good. But we have lumpy months, right? So one month might be 3x what the next month is. Month might be very green and the next month might be slightly red. Those are scary things, but those are growth problems that we experienced. And I was like, I'm losing my mind on some of this because cash projections, a lot of things got complex. So what I leaned into was basically all my, all what I personally took home when I was making quite a bit. And on the entrepreneurial side, I was putting it in real estate with the goal that my cash flow from my investments would, instead of having really bumpy months, that it would hedge that and it would just start to be a little bit more smooth.
Mm-hmm.
So that's our goal with the income fund. And we pay a set return. There's nothing more stabilized than a literal fixed income return. We pay on our high end 12% for our highest share class. And that's, a lockup period of only 36 months. So our goal was to literally deliver for people that were either moving towards the retirement side. And they said, look, I can't be tied up for too long, but I do want a higher, return in the market that I'm seeing other places today with less risk. Or, on the entrepreneurial side, which is really where my heart is, like, with my background, it was to help people that have high incomes, but might be experiencing lumpiness or might want to hedge their bets of wherever they're at in their career to have that other source of income at a high, return that they could trust. So that's that's the background of it and a little bit about some of the details kind of behind that.
And I know in the past you've been into, and I don't think we talk a lot about some of these phrases, these words that in our podcast. Sure. In the past, you've been involved in triple nets.
Correct.
And some syndication, some industrial. What is a triple net?
Sure. A triple net lease is a lease structure that is remarkably advantageous for the landlord or the investors, really both. And what that does is it creates an expense profile, taxes, insurance, and maintenance that are built into the fees that the tenant incurs on a monthly basis. So they have their base rent on one side, and then they pay their triple nets or their CAMs, both are the similar terms, often overlapping, that cover their taxes, insurance, and maintenance for that same period. So what it creates, the goal at the end of that is that the landlord receives essentially a net income.
Mm-hmm.
So triple net leases are most commonly associated with really high credit tenants. So you have this dual amazing benefit of having, we have multinational companies as tenants for some of our previous syndications, and they're triple net leases. So if they pay, $100,000 a month, and then they have, $20,000 a month in triple nets, then what happens is the landlord receives $100,000 a month because the tenant has incurred and paid for those expenses of the building and for the operations there. It is a extremely landlord and investor friendly structure. And it's something that really it benefits the tenants in a big way as well, because the landlord still manages things like the maintenance, still manages big items and manages a lot of the back end things, but the expenses are shared differently, which allows the landlord to operate the business, much more efficiently.
Absolutely. And, ladies and gentlemen, some of the, examples, a lot of the big corporations, perhaps like a Walmart or Home Depot or Walgreens, what they do is they'll build something on land, but then they'll sell the land because then they get money back in order to build another one. Then what they do is they sell that land and sell this asset to investors. And then all you do is just take care of the property. And if the thing is if they leave, you just re-rent it to someone else, lease it for, 5, 10, 15-year contracts or more. And it's really, you have to know what you're doing. Everybody just don't jump in and buy a Walgreens,
Sure.
or something like that. Go with the professionals, learn how they do it, get a mentor, and then take it from there. Nic, so everyone's concerned about it's election year. 2020, since 2020, it's just been up and down crazy. We had COVID, then we had the Great Resignation, and then we have now the interest rates and GDPs and just printing of money. Wall Street, China sneezes, it goes down, so then it goes back up. Kind of calm some of the fears and talk a little bit about the economy, some strategies, and why it's okay to be scared and be cautious, but it's still okay to invest right now.
So I love that mentality. And I think you hit the nail on the head, Mike, is I mean, I'm biased. I started the best moves I've ever made in real estate, bar none, unquestionably, were at some of the worst, quote unquote, worst
Yep.
timing that I've ever, heard. The great financial crisis, right? The GFC. I mean, we were buying 10 million a week,
Yep.
many weeks of distressed assets. And those deals came out fantastic. So I am wildly optimistic, one, about the US overall over a long period of time. And two, in downturns of the market, this is the best time to be buying. Absolutely. So all that to be said, I'd say the good news is, one, I think it's a huge opportunity right now. Two, you mentioned some things that tapped on like political concerns and all that. The world is an interesting place right now, but the greatest thing about, we can all be very frustrated about things like Congress, gridlocks and problems and right versus left. But what's very interesting is the American system can bend very much without breaking. And so I'm very proud of our country for that. And that, as annoying as our system could be with inefficiencies at times, that we do over the long term have stability that most other countries don't experience. Yep. What I am concerned about, and what I do see as longer term concerning trends, I mean, I hate to ring this bell, but it's inflation. And I've been saying this for I guess about 2 years now. And I'm like, I think we're talking about decades here, not months. And most even friends in the industry are like, no, this is a supply chain issue. This is going to go away. This is going to resolve. And I'm like, that's not what we're seeing. Those aren't the charts we're seeing. Those aren't the drivers. Sure, supply chain, 18, 24 months of reestablishing a stable supply chain after COVID. Okay, but we're outside of that. 2022, middle of 2022, we're looking at, what was it, 9.1, 9.2% CPI for inflation? That's crazy. Now, we've seen a huge reduction. Great. That's really good. But we've seen some surprising trends. We've landed, right around that, low threes mark, plus or minus, depending on the metric you're looking at. But the last couple months have been going up. And not only have the last couple months been going up, we're now seeing the PPI, which is often overlooked, the producer price index, going up a little more concerning, which is often a precursor to CPI, which is inflation. So the crystal ball here is getting, it's leaning a little bit more towards those trends that we're all worried about kind of popping up. It looks like those are popping up. And I see, especially the big names, you see the Rick Reeders, you look at the Bill Ackmans, you look at Howard Marks. I mean, 3 huge names. Those gentlemen are openly in public saying 10 to 20 years of inflation ahead. They're betting on interest rates built into their equations of 5 to 6% for 2 decades. Yeah. So, that's kind of what we're seeing in line, which isn't my favorite thing as a real estate investor to be calculating the 5s and the 6s for rates. But I think there's opportunities in that for investors. That's why I started there saying, when the market readjusts, and we're all doing this right now, I think there's opportunities for investors in there, even with some very shaky inflation headwinds that we see.
So are you, how are you leveraging, if you're going to see 5 to 6%, you're looking at some of the interest rates, do you just get a bigger LTV? Do you sit there and say, you know what, I'm just going to hedge it instead of playing this 80-20, I'm going to raise 40%, I'm going to do more to kind of mitigate that type of payment?
So that's a great question. On the industrial side, we've paused syndications, candidly, because industrial is the timing's very different for industrial. I know you guys crush hotels, right? You look at hotels, you look at multifamily, even some self-storage. There's this huge benefit that those there's a huge benefit that those industries have and those market segments have, where you can ride the wave of market trends up and down, and you can kind of bed into that. So the benefit of triple net leases are what we talked about. The downside of many of those is that you have one tenant. Right? One. So if you mistime the market cycle with a single tenant asset that's, say, 150,000 square feet, which is very expensive, lots of money every month, you actually could screw up a 5-year cycle, 7-year cycle, 10-year cycle. So that's something that we are seeing in the industrial side. We have paused syndications there and focused more on the mortgage side, because the mortgage industry that supports a lot of, a huge amount of the US real estate economy is so rock solid, and it does have a longer term stability. So what we're doing on the mortgage side to counteract that is we're just being more aggressive with purchasing. We're saying, look,
Hmm.
we need bigger discounts on the mortgages that we buy, the pools that we buy of mortgages to offset some of this longer term 10, 20-year risk. I mean, the partners that we buy from, the financial institutions, the banks, they don't always appreciate that as sellers taking a little discount, right? But they understand the conversation that's being had. So it's not as offensive as because we're really transparent on our numbers on the buy. That's really what we're looking at, is really making sure that we're buying the right mortgages.
Yeah.
We're filling the portfolio with smart buys, that we're not over our skis on too many assets and not enough cash, or vice versa. It's just really building in the expectation of the higher cost of capital into that.
Mhm. Yeah, and that's something that we can do as experienced investors. And a lot of people, if you're new to this and you don't know really about how you're buying into it, we kind of build it into the structure of when we look at it, and when we do our due diligence, we add those numbers in. And sometimes, like in the hotel industry, we're starting to see some depressed assets because they just were mismanaged during COVID, and they've been just kind of riding and burning and burning and burning their fuel. And we're starting to see that. But then now we're looking at how can we build it up and what can we build in? And now I have to sit there and say, okay, like you said, 6-7% interest rates, and I have to build that into my pro forma. And it's just something that you learn. If we were all sitting at 2 and 3%, we wouldn't be learning anything. We'd just be vacationing in Bali or something like that.
Right.
But so Nic, are you using AI at all? Are you using that's kind of like the big thing as far as using AI to help you invest in the power of that.
Absolutely. Yeah. So I really like, I really like Ray Dalio in many, many ways, especially his earlier books were fantastic. There's so much to learn from Ray.
Hmm.
And one of the things that early Ray Dalio did that was so mind-blowing was incorporate AI before anyone else was doing that, right? And more recently, I disagree with Ray Dalio more and more on a lot of his final points that he makes. But that first 90% of what he's done on many of these huge studies, huge books, huge research projects that he's done have been so enlightening. So we've actually been tapping into AI in interesting ways for the last handful of years, especially as it relates to underwriting and checking assumptions. It's trying to get advanced kind of predictions and marking that versus what are human-made predictions and our more traditional methods, and checking both against each other and then back checking those, what actually happened in the market 6 months later. So that's been very interesting. I wish there was a program that really was locking it at an extremely high level, and I could say this is the clear winner on that. But we're testing that more and more and more. And we're also testing how it looks at the end of the day when you are overlapping AIs with AIs and comparing AI projections with each other. So those are two things we're just seeing is the early stages of that. I'm also liking the research component of AI right now. What was I playing with earlier? I'll try and just give a shout out to, I'm not affiliated. I think it's called Consensus AI. And it's basically, Consensus is basically, if it's the one I'm thinking of and everything, it's basically pulling like high level sources together to help with information. So you or I might go into a very high investment situation to look at things like the Bloomberg terminal, which is like, I don't know, hugely expensive, inaccessible to the average investor. It's thousands and thousands a month. But Consensus offers the everyday investor really valuable resources. And again, I might be getting the tool wrong because I've been playing with some this week. But things like that. It's a high, like the higher level scraping of information, the higher level compiling of information. ChatGPT and OpenAI are great, but the more niche tools that are pulling out the top sources and then more of the predictions and projections. That's the top ways we're finding for AI right now. And then a whole bunch of little fun stuff of, playing with marketing.
And, I found out that, ChatGPT and some of the more common ones, and ladies and gentlemen, if you do this in writing your blogs and things like that, be very careful, because I found out that I can write the same article, use 3 different AIs, and the biases among the 3, one I can tell, it's like, okay, I bet I know where this is coming from, because it'll say landlords suck, and you can do this and just don't pay your rent, and you can get away with murder and things like that. And then another, and the other one's different. Then the other one's different. It's like, what, you really have to still fact check. AI is still new, everyone. Don't get yourself in trouble. Fact check, and make sure it's good for your state, wherever you live in, and the type of government you have within the state. But I was just doing that the other day, and I'm like going, wow, this is like really biased towards the tenant, and I just asked it a very simple question, and it's like, not in Arizona. Yeah. And so you have to switch
Maybe
it.
in California, Mike. Maybe that's a California.
It was a California AI. I think that's what it was. It's like, just don't pay your rent for 6 months. They can't do anything about it. And I'm like, how about 5 days?
Yeah, look what's happening to LA County on their rent collections.
That's right.
I'd caution people for that, but
That's right. So, let's, well, before we wrap up, let's get into Saint Investment. Everybody is Nic DeAngelo, saintinvestment.com. When people go there, what do they click on? What are some of the resources? Tell us a little bit about the website.
So Saint is really an investment project for us. It's an investment platform. The goal with Saint, and where the name came from, is that I started a nonprofit many years ago, and I was so head deep and just nose down in the entrepreneur side that I wasn't able to really service the nonprofit and do the those that I wanted to do with it. And the nonprofit, the things that were most important to me, the number one was entrepreneurial education and investing education. Those were the number one things. So I donated times at schools. I tried to spend a lot of time, but I was just limited because I was working 80, 100-hour weeks, right? And so really crazy scheduling. So what we did at Saint, we're already doing the research. We're already doing all the work, right? So the goal with Saint, our resources section, so saintinvestment.com/resources, is to give it all away for free. It's to literally say, we're doing this economic research. We're doing this research on new business trends and new strategies. Here's a whole section of our findings. So we hold monthly webinars where we dive in and talk about all kinds of things. The greatest transfer of wealth of all time, $70 trillion being passing down from the baby boomers to future generations. Huge trends that we're seeing in the real estate sectors. And the goal is just to give that away, because the more educated investors are, the more they understand the benefits of real estate, the strategies in the economy, how to navigate successfully. Because, I love the country. I want people to be successful, especially in kind of the wonky times we're in. Mm-hmm. So it's all free. I don't even think there's a login for any of this stuff. You can go and watch the videos, do whatever. And if you guys have questions, or if, the audience has questions and they're watching, they can drop questions and we'll answer them. So we try to just be as transparent as possible.
And that's fantastic. So many people are like going, why do you do this for free? You can make more money and this or that. And I really thank you and applaud you for allowing people to learn, because that makes them better investors and also better LPs, because now they know the questions to ask the GPs to better be informed so that they don't get taken advantage of. So thank you very much for that.
Yeah.
How else can people find you? LinkedIn?
Yeah, add me on LinkedIn, hit me up on socials. I'm on Instagram. We post a lot of cool stuff. I respond to a lot. Still, the best way is going to be the Saint website. The resources section has it's just really, that's where all the gold is. But I'm on the LinkedIn, I'm on Instagram, and I'm pretty active. So if anyone wants to connect, I'm around and can always chat.
Fantastic. Nic DeAngelo, saintinvestment.com. Before we leave, I've got to plug our sponsor. That's always important. Today's episode is brought to you by REI Words. If you're a real estate-based website and you want your DR rating to go up, you're trying to get social media, you're trying to get blogs, you're trying to get known, contact REI Words. They are your go-to SEO agency for increasing traffic to your real estate website. Check them out at reiwords.com. unmatched.com. Nic, it's been fantastic having you on the Richer Geek Podcast. Have a great night.
Mike, appreciate it. Always great catching up with you, man.
Thank you, sir.